Hello, this is Bob Steele. In this lecture we will talk about Chapter 21, Cost Volume Profit Analysis. We're going to start off with fixed costs. We're going to take a look at identified cost behaviors. So we're going to use the Cost Volume Profit Analysis. The Cost Volume Profit Analysis is basically going to break out the income statement in a bit different format than we have looked at before. We've looked at income minus cost of goods sold minus other expenses. And in this case, we want to break out the costs and revenue in accordance with their nature, meaning are they variable costs, fixed costs, or mixed costs? And in so doing, we can then budget different scenarios more easily. So we're trying to think of what if we do certain things moving forward, what will be the effect on net income, breaking the costs out between these categories of cost behavior rather than the revenue minus the cost of goods sold can help us with this. So questions that this could help us with are like, how much does income increase if we install a new machine to reduce labor costs? So if we're thinking about increasing or implementing a machine to reduce the cost of labor, we need to be able to budget that. If we break our income statement down into fixed and variable costs, it will be easier for us to do this. So other questions, what if the change in income is selling prices declines and sales volume increases? Meaning, what if we try to reduce our sales cost per unit? Will that increase our sales enough to make it a worthwhile decision? Should we reduce the cost in order to increase sales? What would be the effect on the bottom line on net income? Or how will income change if we change the sales mix of our product or service? So if we change the types of things that we sell, if we mix up how much of the different products we sell, what will be the effect on the bottom line? And finally, what sales volume is needed to earn target income? So if we're shooting for a target income, how much sales do we need? How many units do we need to sell in order to hit that? So in order to do this, we're going to break costs out into fixed costs and variable costs. So if we look at these two graphs, we're going to try to analyze the behavior of costs. And first we're focusing in on the fixed cost, which is this line here. So we're talking about the blue line, and what we have here is the cost, and in this case the fixed cost, and the volume in units. So as we produce more units, like more inventory, notice that what happens to the fixed cost, it stays the same. And if you think of a fixed cost, I often think of it as the rent. The rent stays the same. If you are renting something and you live in your house and you spend all day long in your house, then it's still the same price as if you went on vacation and you didn't use your house at all. The rent is the rent. It's fixed no matter how much we use it. On the other hand, well, we'll talk about variable costs next time, but if we looked at the relationship of per unit fixed costs and variable costs, it would be looking like this. Again, we're focusing on the fixed costs. Now what happens if we think about the rent as we produce things? So, for example, if we produce pastries in our house and we're applying the rent of the factory or the house to the pastries, then if we paid $1,000 for the kitchen that we're making the pastries in and we made one pastry and that was our inventory, the cost of that one pastry would be $1,000. On the other hand, if we paid two pastries, then we would say the cost of the $1,000 rent would be split $500 between the two. If we made four pastries, then we could split it, 25 between the four of them, and so on and so forth. So the idea of the cost per unit for fixed cost is that we want to produce at capacity. We want to produce basically as many as we can, because notice that the per unit cost goes down. So the more we produce, then we're going to divide that rent into the number of units we produce, and that therefore the cost per unit will go down. We contrast this behavior to its opposite type of cost, for the most part, being variable costs. And variable costs are going to be represented by this line here. And you'll notice that variable costs, if we take a look at as the units would go up, as we make more pastries, if that was the example, going up, the cost behavior stays constant, meaning it goes up at a constant rate, meaning the slope of the line is going up at a constant rate. And as opposed to the fixed costs here, which we just looked at, which stays the same. Fixed cost is $1,000, whatever, and then the variable cost is going up by $20 per unit. And that just happens every time we do it. So that would be something like if the sugar in the pastry or something like that, that would go up each time we make more pastries or more batches of pastries. If we take a look at the relationship on the per unit cost, on the other hand, notice that no matter how many pastries we make, in terms of a pure variable cost, it's still $20. So if we made the 1,000th pastry, it still costs another $20 of sugar and whatnot. So the cost per unit stays constant, whereas we just looked at the variable cost. The cost per unit for the fixed costs go down as we produce more. And then the last thing we have is the idea of mixed costs, meaning, well, this isn't the last thing, but we have the idea of mixed costs, which will have a portion of the variable costs and a portion of the fixed costs. So, for example, in this case, we have the total cost here represented by the green line. So notice that the green line starts at this jump. It starts here at the fixed cost level, and then it's going to go up, because even if we didn't produce any pastries, we would still be paying the fixed cost here, and then every pastry we produce, the fixed cost stays the same, but the total cost will go up in the same level, $20 per unit, as we produce more pastries. We could also have a stepwise cost. So the idea of a stepwise cost meaning that we're going to have a similar cost until something happens. So we might, for example, be paying the wages for a department to run a department, and we pay the same wages until we basically open a new department or open another section in that department. And in that time, we're paying a fixed cost, and then it steps up because we have to open a whole new department and hire a whole new group once that step has increased. So we could have a cost behavior like this. And when we're projecting things in the future, of course, this behavior of cost can often be more useful to us than looking at a traditional income statement, because we want to make predictions into the future, and the behavior of the way the costs act is the best way to make those predictions.